Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Sector-specific ETFs are gaining traction among investors who want precision in their portfolios. Instead of spreading bets across the entire market, these funds let you focus on industries like healthcare, XLV, or consumer discretionary, XLY. Whether you're bullish on tech or think energy will rebound, there's likely an ETF built for that strategy. These targeted funds offer exposure without the hassle of picking individual stocks. For example, XLV tracks top healthcare companies, while XLY follows consumer brands. If you've ever wanted to invest in a sector's growth without overcomplicating things, sector ETFs could be your answer. Let's break down how they work and why they might fit your portfolio. What are sector-specific ETFs? Sector-specific ETFs are investment funds that focus on a single industry or segment of the economy, like healthcare or technology. Instead of holding a diverse mix of stocks from every corner of the market, these ETFs zero in on one area, giving you targeted exposure. Think of them as a spotlight, while broad market ETFs, like SPY or VTI, illuminate the entire stage. Sector ETFs shine directly on the performers you're most interested in. These funds track indexes tied to specific industries, bundling stocks from companies within that sector. For example, the Healthcare Select Sector SPDR Fund, XLV, holds giants like United Health and Pfizer, while the Consumer Discretionary Select Sector SPDR Fund, XLY, includes Amazon and Tesla. The goal? To capture the growth, or declines, of an entire sector without the need to pick individual winners. How sector-specific ETFs differ from broader market ETFs. Broad market ETFs spread your investment across hundreds or even thousands of stocks, mimicking the performance of the entire stock market. They're like buying a pre-made salad with a little bit of everything. Sector ETFs, on the other hand, are more like ordering just the avocado. You get concentrated exposure to one ingredient. Targeted exposure. Sector ETFs let you bet on industries you believe will outperform. If you think tech will surge, a fund like XLK, Technology Select Sector SPDR, gives you direct access. Higher risk, higher potential returns. Because they're not diversified, sector ETFs can swing harder. A boom in energy stocks might lift XLE, but a downturn could hit it harder than the broader market. Flexibility. Want to overweight or underweight a sector based on trends? Sector ETFs make it easy to adjust your portfolio's focus without trading dozens of individual stocks. Common sector classifications. The stock market divides into sectors under the Global Industry Classification Standard, GICS. Each represents a different slice of the economy, and there's usually at least one ETF tracking it. Here's the breakdown. Healthcare, XLV, companies like insurers, drug makers, and biotech firms. Consumer discretionary, XLY, brands relying on consumer spending, from retail to entertainment. Technology, XLK, hardware, software, and semiconductor stocks. Financials, XLF, banks, insurers, and investment firms. Industrials, XLI, manufacturing, aerospace, and infrastructure companies. Energy, XLE, oil, gas, and renewable energy players. Consumer staples, XLP, everyday essentials like food and household goods. Utilities, XLU, electric, water, and gas providers. Real estate, XLRE, rights and property-focused businesses. Materials, XLB, mining, chemicals, and raw materials producers. Communication services, XLC, telecoms, media, and social media platforms. ETFs like XLV and XLY fit neatly into these categories, letting you invest in these sectors with a single trade. Whether you're bullish on tech's next breakthrough or betting on a consumer spending rebound, there's likely a sector ETF to match your view. Benefits of investing in sector-specific ETFs. Sector-specific ETFs like XLV, healthcare, and XLY, consumer discretionary, let you invest with precision. These funds cut through the noise, offering a straightforward way to tap into industries you believe will grow. Instead of gambling on single stocks, you get a basket of sector leaders. Below, we'll explore why these ETFs stand out. Targeted exposure to high-growth areas. Ever wanted to invest in the next big thing, without guessing which company will come out on top? Sector ETFs solve that. For example, XLV bundles top healthcare players like Pfizer and Moderna, so you gain from medical breakthroughs without betting on one drug maker. XLY tracks Amazon, Tesla, and other consumer brands, riding waves of spending trends like e-commerce or luxury demand. These ETFs act like a magnifying glass, focusing your investment on industries with momentum. If you think renewable energy or AI will boom, there's probably an ETF for it. You're not just hoping a single stock succeeds, you're capturing the entire sector's movement. Lower costs and accessibility. Sector ETFs cost less than buying individual stocks, and they're easier to manage. Here's why. Low expense ratios. Funds like XLV and XLY charge under 0.20% annually. That's far cheaper than hiring a manager or trading multiple stocks. Liquidity. These ETFs trade like stocks, so you can buy or sell anytime during market hours. No waiting for mutual fund settlements. Diversification within a sector. Even though you're focused on one industry, you're still spreading risk across dozens of companies. XLV holds over 60 healthcare stocks, while XLY includes 50+ consumer brands. Forget the headache of analyzing individual balance sheets. With sector ETFs, you get instant diversification, low fees, and the flexibility to pivot as market trends shift. Risks and considerations. While sector-specific ETFs like XLV, healthcare, and XLY, consumer discretionary, offer targeted exposure, they also come with unique risks. Unlike broad market ETFs, which spread risk across multiple industries, sector ETFs concentrate your bets. A downturn in one sector can drag your entire position, something to keep in mind before diving in. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.